What is going on, traders? The jobless claims came in today as of the day of this recording. This is a very important metric for the Fed because the Fed wants to see unemployment go up. And they are hoping that the rate hikes that they are doing is going to have an effect on unemployment. They want unemployment to go up because they want to be able to curb spending, make sure that people have less money, as crass as that sounds, so that they can actually put pressure on prices and see prices finally decline. Now, we are getting inflation that is flattening. For sure, inflation is peaking. However, it does not mean that inflation is on a significant downward trajectory, especially in the way that the Fed wants to see before they stop hiking rates, especially as the two-year yield starts falling below the federal funds rate. I'll tell you why this is important. And then because it is T8 Thursday, we will be going over a technical analysis of the markets. I'll show you why I'm still short and how I'm short. What plays do I currently have? But I'll give you my short-term and long-term prognosis on the markets as well as my plays. You definitely don't want to miss it. Let's get right into it. All right, so the jobless numbers came out today, and as I said, the Fed actually wants to see unemployment go up. However, every time an unemployment metric has come out thus far, unemployment is actually trending the other way. Right now, we are seeing jobless claims falling to a 4-month low. We saw the last unemployment report come in at 3.5%, which is the lowest unemployment since 1969. Now, we are seeing more and more layoffs start to come in, especially with the mega cap companies. I actually sent this out on Twitter the other day. By the way, follow me on Twitter and Instagram where I post free daily finance content. I also post a ton of plays and chart setups, all for free. So it behooves you to follow me on there. So follow me on Twitter and Instagram. But Coinbase, BlackRock, Salesforce, Bed Bath & Beyond, Goldman Sachs, Amazon, Meta, Alphabet, Microsoft, Stitch Fix, McDonald's, most of these mega cap companies, especially mega cap tech, are reporting layoffs. However, most people are not employed by mega cap tech. However, something tells me that we are going to finally, in the next round of jobless claims and unemployment numbers, we will finally start to see those trending up. I do think that we hit the trough or the lowest point of unemployment numbers. And based on the news cycle in the last month, I do think that those are actually going to start hitting the broader unemployment and jobless numbers. And we will start to see those things trend up. Now, let's talk about this right here, this graph. This is the 2-year treasury, which is in red, and the Fed funds rate, which is in blue. I've talked about this before, but in short, it is a very bad sign when the 2-year treasury falls below the Fed funds rate, because the Fed funds rate is considered an overnight rate, right? This is the rate at which banks borrow from each other. So if the 2-year if what banks would get for a 2-year treasury is now less than what they would get for overnight, then that is a sign for how broken things are. And you don't need to be a bond expert in order to know that, right? One other thing is that I want you to see what happens here to the Fed funds rate right before recessions, right? The Fed funds rate starts peaking and the Fed ends up holding these rates for longer, trying to fight inflation in these different cycles. And then when they cut rates, it's because the shit hit the fan. And this is when you get a recession, right? These gray bars here. So we're going to get to a point where the Fed actually holds these rates higher for an amount of time. It will be dictated by what the CPI is doing and how fast inflation is dropping. But the reason this is significant is because we know now that the Fed is close to pausing. I still think that by February 1st, we will get a 25 basis point rate hike. That is actually what is priced in. You can see here that there is almost 100% probability by the Fed fund futures market that the Fed does a 25 basis point rate hike. But once the 2-year falls below the Fed funds rate, that is when the Fed actually pauses and keeps those rates, whatever the rate is at that time, keeps them up there. So if the Fed does a 25 basis point rate hike, the terminal rate, if they do stop, will be between 4.5 and 4.75, which is what initially the Fed has projected would be their rates, just under 5%. So it would make sense to hold it there for quite some time and see if finally what they have done is going to actually have an effect on inflation, or the intended effect on inflation. So my guess is that they will raise 25 basis points and they will hold it at this range, the 4.5 to 4.75, for the next few months. And then maybe by second half of 2023, they will look at cutting. But I think that after February, that a pause is going to come. So I don't think that they're actually going to raise in March. And I just want to pause here and remind you that January 28th, we are doing a free mastermind, a free webinar for you guys. We're going to go over topics such as futures versus options, technical analysis, different day trading strategies, different futures trading strategies, different options trading strategies. It is really a jam-packed mastermind. This is our regular mastermind call. We're just opening it up to the public so that you can get a glimpse for what we do. And spots will be limited because we're limited by the number of seats that Zoom can hold. So make sure if you want a spot, it's absolutely free. Just click the link you'll see it in the pinned comment and sign up. But if you do, make sure that you attend so that you're not just taking up a spot that somebody else might want to join. So I appreciate you guys. Click that link if you want to join January 28th. All right, so that's the news on the jobless claims as well as on the Fed funds rate. But let's jump into a market update since this is a TA Tuesday. If you guys remember from the last video, I was saying why I think we will still get rejected from this line and why I think it's still an optimal short from here. From my perspective, when I'm trading, whether it's day trading or swing trading, I don't change my perspective based on what I think is going to happen on a whim. I'm following the trend. And if the trend is still valid, then it is the smart money play to play the trend until the market proves to you that the trend is no longer valid. So, could we have broken out of this? Yes. And I saw a lot of chatter on YouTube as well as on my Twitter and Instagram saying that, everyone is going to go short here, so the market is going to do otherwise. Guys, this is called gambler's fallacy, right? You see this all the time where you think that the odds of something are not as high as they really are. So for instance, if you're on the roulette table and you see, 10 black numbers hit, you think that the next one is red. However, it's still a 50-50 draw or almost 50-50 draw if you include the greens. But it's gambler's fallacy to say, oh, this happened, these events happen 10 times in a row. It's less likely to happen again. So in this case, same thing. It's like, oh, we've hit this trend line quite a few times. And there's no way that the short could be this easy, but yes, it can. And I proved this last time when we actually took a short in December, and I maintained my short positions here as well as opened up new shorts on SOXL, which is the semiconductor ETF. And here's my Robinhood account that I use only for shorts in the last 3 months. It's up 53.7, but you could see the spike here was on December 14th. It was basically when I went ahead and shorted this trend line once again. You can see here, this is December 14th, once we hit that trend line. I also went ahead and shorted SOXL because we were coming up on resistance here. I'm not going to go through exactly this trade, but there was an imbalance created by a breakdown gap. We were at the golden pocket. So I shorted SOXL by not only buying SOXL puts, but I also bought SOXS, which is its inverse. And these SOXL puts are up 56% already. So guys, there's no reason for you to just sit on your hands and watch your portfolio bleed. Of course, I'm a huge proponent and fan of long-term investing and dollar cost averaging, but in the meantime, I also do want to take advantage of the skills I have in order to trade the market and make money in the meantime. There's a lot of money left on the table here if the only thing you know how to do is buy stocks and pray that they go up. So if you want to learn how to do all of this, again, join the mastermind. You'll get a glimpse of what we do, but also join the academy where we send out all of our analysis, trade alerts. You get to chat with thousands of traders about this stuff all day, every day. Bounce your ideas back and forth. Is this a decent short? Is this an optimal play? Should I trade futures? Should I trade options? How do I trade futures? These are all discussions that we have every single day. So fast track your learning and join a vibrant community of traders. But here's my take on what is going on with the S&P 500. Again, not rocket science, right? We are at a trend line here, a major trend line that has been established since January 2022. And again, I'm going to keep playing that trend line until that trend line is no longer valid. The VIX was also at support. In my last video, I was saying that every time that the S&P 500 actually hit this trend line, the VIX was at 19 and we were at 19 once again. And I saw this really interesting piece of analysis here by a Twitter user named Heisenberg, but he said the last time The last 3 times that the VIX had 4 consecutive days below 20 were August, April, and January of 2022. Each time markets topped and led to 19, 21, and 14% declines respectively, right? So it is in line with, if that data is correct, I didn't corroborate it, but I'm going to take him or her at their word. If that data is correct, then it corroborates, what I was seeing as well with regards to the correlation between the VIX and the S&P 500. So shout out to that Twitter user. Thank you for consolidating that info. We have the FOMC coming up on February 1st, right? And if Jerome Powell does not raise rates, because I do think we're very close to pausing here. I'm on record as saying I do think we'll go 25 basis points on February 1st and then potentially pause from there. We are very close to pausing, whether we pause after February 1st or after March. I think pausing after March is inevitable in my estimation. But if we go 25 basis points, I think that is expected. If we go heavier than 25, I think that is even more impetus for the market to tank. And if they pause, I do think that the market can break through this and actually rally if we pause on February 1st, which I don't think is going to be the case. Otherwise, I do think we get rejected off this trend line. And I do think that the earnings that continue to come out with the mega cap stocks are really going to dictate whether we break below the October lows or not, right? If we actually start to see a lot of earnings compression this round of earnings, I do think we can break the October lows and head to those pre-COVID highs that I talked about. But one other thing that's interesting, if we take a look at the monthly chart here on the S&P 500 and we pull up the EMAs. If we pull up the EMAs here, this is between the 8 and 21 EMA. Let me just remove the indicators from today's day trades. Look at the 8 and 21 EMA. In 2008, on the monthly chart, we crossed that. Also in 2000, which was the dot-com bubble, we crossed the 8 crossed below the 21. And we also see it now. The 8 is below the 21, the orange line below the green line, right? There was one time where we faked out. It was right here in 2011 where we faked out and it actually created a market bottom. An interim bottom after the 2008 financial crisis, right? We did see the 8 momentarily drop below the 21 here back in 2010, actually. It was summer of 2010. So, these moving average crossovers on the longer time frames are more reliable than, say, when people are looking at it on the daily, where, you have price action dropping below moving averages all the time. But I mean, we've been below this now since September 22. So 1, 2, 3, 4, 5 months. I think we do have to take this seriously. And if we're just looking at this indicator alone, that then does give us more fuel to drop to the pre-COVID highs, which you see here outlined in this orange dotted line, which would put us at around 3,400 on the S&P 500. But I mean, here is the silver lining. Even if we do get to the pre-COVID highs, that's another, 13% drop from here. So I do think that technically by the numbers, we are closer to a bottom than we are to a top, because we're currently down about 20% on the S&P 500, more than that on the NASDAQ, right? So do I think we'll see even a much bigger drop than what we've already dropped? In my view, I don't think so, especially if the Fed goes back to easing policy towards the second half of 2023. I know that the Fed members and the Fed president said that they don't foresee it. However, the bond market rarely lies, right? Currently, the bond market is still pricing in that the Fed actually starts cutting rates by second half of 2023. And then we also have this, where the 2-year dropped below the effective Fed funds futures rate, where we typically see the Fed start to pause right after that happens. So I do think, again, that pause is coming sooner rather than later. I will continue to be positioned short here until the market proves otherwise. I don't tend to take many counter trades. I trade along with the trend. And by the time that trend is exhausted, I've already made a good amount of profit trading with the trend. So I'm not going to try to counter trade this. I will be dropping a video soon showing the difference between a play that we had on, because I get this question all the time. What is the difference between trading futures and trading options. Can you give us a sense for what is the risk to reward with each? How much does it cost for each? Can you make more money with futures versus options? And today was a good example because I took an options just to actually make this video. I did go short. It was a real play. I did go short, but I took it on the future side as well as on the option side in order to produce the results and tell you what were the results of each. So I will be making a follow-up video, after this one. So if you're interested in that, make sure you have your notifications turned on and sign up for that webinar January 28th at 12 p.m. Eastern time. If you want access to all of our trades and analysis and courses, link is in the description below. If you decide to participate in the mastermind, I will see you guys there. Otherwise, I still love you. Leave a comment down below. Let me know what you think of this analysis. I try to respond to every comment. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.